Well, the economy looks like it's all over the place. I mean, some people are out there, like John Williams, showing the real numbers, which I believe, which say it's not very good. Other people are out there, like the president, saying the economy is the best it's ever been. We have a 3.8% inflation rate. The yield curve is not showing that. And a guy who wrote this book a few years back, I'm giving it away. The coming bond market collapse. This is the bonds going down, and rates will be going up in another airplane there. But anyway, I have Michael Pento. Michael Pento from Pento Portfolio Strategies. You're a money manager. You're a published author. You write a lot of stuff on the web. The most recently, you talked about the yield curve inverting, and also the even more recently than that, the most hawkish Fed, and they're kind of related. What's going on in the economy with the yield curve? It's inverting. It's like, I don't know, between the 10 and the 30-year note is like 12 points, 12 basis points?
Well, Greg, the curve that I look at is the 210 spread. I think that's the most important and most influential. But I don't want your audience to go to sleep and say, well, geez, this guy's going to talk about the yield curve. Let's just back up and clearly explain why an inverted yield curve is so vital and so crucial. So what is a yield curve? It's basically the spread between the 2-year note and the 10-year note, or basically it's the spread between short-term rates and long-term rates. Well, what is the controlling factor for short-term rates? That is the Federal Reserve. The Federal Reserve basically controls the Fed funds rate, which is the overnight interbank lending rate. Overnight, it's the shortest rate, and all short-term rates are pegged off of that rate. So the Fed kind of controls that rate. However, long-term interest rates are much more concerned about inflation and deflation and growth dynamics. And that's the case, especially when the Fed isn't engaged in QE, buying long-term treasuries. And that spread is very telling. So when the economy is very healthy and very robust, and there's inflation and growth, that spread is very wide. And what happens when that spread is very wide? Banks tend to lend a lot of money. We have a debt-based monetary system, fiat currency regime, and as the Fed and banks make loans, the money supply grows. And when the private sector pays off loans, that debt is retired and the money supply shrinks. That is why the spread is so very important. So when the banks stop making loans, money supply shrinks. Now, why would a bank stop making loans? So when the yield curve inverts or gets very narrow, right now the spread between the 2 and 10 is about 30 basis points. That's the lowest it's ever been since 2007, just prior to the Great Recession. So when the yield curve gets very narrow, the bank's net interest margin goes almost to zero. So if I'm a bank and my deposits are costing me just about as much as my loans are generating an income, I stop making loans, especially when I know that those loans are probably going to default. So think about it, right? I have a deposit that's costing me about 3%. I have a mortgage that maybe I can earn 4 or 5% on, and I know that that mortgage is probably going to default and become a bad loan. I'm not going to make as many loans, and the money supply drops. Now, let's look at the why do I care if the yield curve inverts? Because 9 out of the last 10 times the yield curve inverted, we had a recession, going back to 1955. And the one time in the 60s when we had an inversion and there wasn't a recession, the economy slowed down very, very, very dramatically. We virtually had a recession then. So basically, it's almost every time post-World War II, the yield curve inverts, we have a recession. And then you say, well, Mr. Pento, why do I care if there's a recession? Well, the last 2 times the yield curve inverted and we had a recession, we had a stock market drop 50%. The S&P 500 lost 50% of its value. So if you're an investor, you have money in the market, you definitely care about recessions. If you care about recessions, you care about an inverted yield curve. And if you care about an inverted yield curve, you better pay attention, because the yield curve is the narrowest, the spread is the narrowest it's ever been outside of the start of the Great Recession that commenced in December of 2007.
Can this time is it going to be different when is the Fed going to be able to rush in and they're going to be able to save the economy again? And a lot of people are like, well, if it crashes, they'll just start printing money and they'll save the economy. Can they do that this time? Can they save it again?
Well, first of all, the amount of ammo that they have to save the economy is much less. They usually have 525 basis points or more. They had that much prior to the start of the Great Recession. So the most they can do now is take back 200 basis points. But not only that, balance sheets across the world are very, very much in distress. So the Fed's balance sheet was only $800 billion prior to the Great Recession. Now it's $4.3 trillion. So I don't think they're going to be able to really greatly increase their balance sheet dramatically. And if they do come out and say, hey, listen, Mr. Market, the economy, the yield curve inverted, the economy is headed into a recession, we are going to now stop raising interest rates. They're pretty much telling the market that, hey, we have monetized, permanently printed money, permanently bought assets, and will never be able to shrink the balance sheet, and we will never be able to normalize interest rates. That is a prescription for runaway inflation. The Fed is going to be very loath, very reticent to take that particular tactic. They're going to try to pretend that, hey, everything is fine. We solved all the world's problems. We can raise interest rates. We can normalize them to 3% or 3.5%, which is the new normal now. It used to be 5 or 6% on Fed funds. Now we're hoping to get to 3%. And we can sell our assets. We can drain our balance sheet from where the high of $4.5 trillion all the way down to $2.5 trillion. No problem. The economy's doing great. The reason why they can't do that is look what's happening to emerging markets and the U.S. dollar. The U.S. dollar is having a great run. It's been on a bull market now for the better part of this year. Our model portfolio said to go long the dollar, contrary to much people who think like me, who think the dollar's doomed. It might be doomed in the long run, especially against gold. But I hasten to say that the dollar might not be doomed against the Japanese yen or the Eurozone's euro. I mean, that would be a very hard position to take, a very untenable position to take. The dollar can go down against the Japanese yen when the Japanese economy is halfway into a recession. They had a negative Q1 GDP print, and their central bank owns everything, bonds and stocks, and they're stuck at zero forever. So why would the dollar go down against the yen? That's not really going to happen, in my opinion, at least not in the short term. So what happens is the emerging markets are getting crushed. Look what's happening in China. Chinese shares are down 23% this year. And emerging market chaos is around the world, very, very salient. And their currencies are crashing too. If you look at in Poland and Venezuela and Argentina and Turkey. And why is it happening? As I said this for years. The Federal Reserve cannot normalize interest rates on its own. It cannot be a unilateral project. It has to be done on a multilateral basis. That's not what's happening. The Fed is way ahead of every other central bank. They have stopped QE. They have raised rates 7 times. They're supposed to be on, at least on record, saying they'll go again in September and again in December. They are on pace to drain the balance sheet at a pace of $600 billion each and every annum until they get down to $2.5 trillion to $3 trillion on the balance sheet. So the Fed is way ahead of the other central banks, and our, even though our growth rate isn't spectacular, we had a Q1 GDP print of just 2%. So when Trump says this is the best economy ever, I hasten to disagree with him. But we're going to have a pretty decent Q2 print, and we're far ahead of Japan and far ahead of the rest of the developed world. So growth rates are better here. The difference between the central bank in the United States, our Fed, and other central banks is trenchant, extremely deep in cutting, and that's why the dollar is rising, and that's why you see chaos around the entire world of emerging markets.
You're seeing chaos because the dollar's rising and they're freaking out when they have this 11, I think in one of your article you said there was 11 trillion just in emerging markets. Well, everybody who's facing the dollar and denominated dollar debt, I don't care where you are, it makes the debt harder to pay back, yes. Right? Is that what the chaos is about? Explain.
That is exactly right. So if I take out a loan in, Argentina famously floated this 100-year bond in dollars. That's part of the $11 trillion in debt that's dollar denominated. That doesn't mean that's $11 trillion in debt. It's dollar denominated foreign debt. And as our dollar rises, it's much harder to pay back that debt because it takes a lot more pesos to pay back in dollar terms. And that's why we see panic. And, you look at what happened in the summer of 2015 when the Chinese devalued their yuan. The market dropped 10% in a matter of a couple of weeks. And that's why the Chinese are scrambling. Let's be honest. The synchronized global growth story is over, Greg. It's done. We had an abeyance in the Fed's rate hiking campaign in 2015. All the way from 2008 to the end of 2015, the Fed only was able to raise rates one or two times. Very, very small increments there. And just about the same time, we had a huge credit impulse from China. And the ECB was in the middle of their 80 billion euro money printing spree. That's why you had temporarily a synchronized global recovery. But what do you have now? The Fed has ended QE and has raised rates 7 times and is draining its balance sheet at the rate of now $40 billion per month. Started in Q3, July, $40 billion a month. That's the equivalent of a couple of rate hikes added to the rate hikes they're already doing.
It's more debt on the market.
It's more debt on the market. And I'm glad you mentioned that because the annual deficits in fiscal 2019, which begins in October, which is just a few months away now. It's funny how fast the year's going. But in a few months now, our deficits go to $1.2 trillion. But this is as the ECB now is gone to $15 trillion in money printing in October, same time in October, $15 billion in printing from $30 billion per month. They go to zero at the end of the year. So you have global central banks are changing their monetary policy with the exception of Japan. They're becoming hawkish. And the credit impulse from China is completely turned upside down. I mean, the credit boom in China, even the communist Chinese government realizes that this house of cards has come to an end. They have to pull back on that credit. They have no choice. Otherwise, the yuan would completely implode and crash against the dollar. So the global synchronized recovery is over, and you have the complete opposite. That is what's happening right now, and that is why the yield curve is inverting. And that is why the yield curve, once it inverts, the money supply gets cut off, and that's the fuel for asset bubbles. We just had record increase in home prices. I mean, what are home price to income ratios are almost as high as they were back in the peak of 2006.
Wow.
We still have trillions of dollars in negative yielding debt around the world. And of course, stock prices, especially in the United States, are way over their skis, 145%. The market cap of equities, 145% of the underlying economy. That really has never happened before outside of March in the year 2000. So as I like to say, this is the most dangerous market ever. And if you are riding this wave with leveraged longs bets on FANG stocks, oh boy, you're in deep trouble.
How long can this go on for? I mean, if you're talking about how the Federal Reserve's draining their balance sheet at $40 billion a month, and they got all these dollar-denominated debt in emerging markets alone at $11 trillion, and everybody is cutting back. I mean, everybody's acting like this is 1999. I mean, we can just keep partying, everything's fine. When does the party stop?
Well, I've put a check mark on my calendar in October because of the fact that the rate of quantitative easing in the Eurozone goes to 15 billion per annum, because the trade war will reach a crescendo then, because I believe, unfortunately, for those who are conservative in nature, that the Republicans lose the House of Representatives, because of the fact that the Chinese credit boom will be in full reverse by October. There's a confluence of events occurring in October that I think could be the start, and I shouldn't say could be the start, let me just pull that back. We've already now entered into a bear market, the beginnings of a bear market around the world. And I can tell you that the top 22 banks in the world are in a bear market. Look at Deutsche Bank, SocGen. There's a billion. There's many examples of small caps, mid caps, and large cap banks around the world that are in a bear market. But the top 22 are in a bear market. You have a bear market in Chinese shares. You have, I believe, 20% of the S&P 500 is in a bear market. So we are starting this is an incipient bear market that's already beginning, but I believe it manifests clearly to even the people who work on CNBC by October that we have entered an official bear market. That's the time frame. And I'll tell you one thing. This is one of the reasons why I think it could be very, very salient, this next bear market. If you look at the structure of corporate debt, I've identified not the housing market as the nucleus of the next recession/depression, but corporate debt. We have a record amount of corporate debt outstanding right now. It's 45% of GDP. It has never, ever been higher. But the quality of that debt, so if you look at the quality of the tranches of debt, investment grade debt is supposed to be very, very solid. But triple B, which is the lowest rung, the lowest tranche of investment grade debt, accounts for 50% of investment grade.
Oh boy.
And the number of zombie companies is at a record high. So when you look at zombie companies, what does that mean, Mr. Pento? That means that companies that have to issue debt just to pay interest on existing debt. So there's a record amount of debt. The quality of that debt is at a record low, and you have companies in a record amount that are just existing as zombies, meaning they have to issue debt to pay back existing debt. So when the credit cycle turns, this is why it's so crucial to watch the yield curve and to watch what's happening around the globe. Why are we so afraid of a recession this time? You imagine the number of zombie companies is going to surge when we hit a recession. And the amount of credit defaults are going to surge. By the way, I forgot to mention, the amount of high yield debt, think junk bonds, and leveraged loans, which is packaged into something called CLOs, collateralized loan obligations, is also at a record high. So the construct of corporate debt is so dangerous that when we hit a recession, defaults are going to skyrocket like we've never before seen. And you talk about the layoffs, and the plunge in the market, the plunge in economic growth on a global basis. This is why, it's so important to have people, venues like yours, Greg, where people like me can come on, take some time, expound upon these data points and the extraction of the data points so people can understand how dangerous a situation this really is.
The guys on CNBC, I know we've talked about this before, even David Stockman said the same thing. He said, Mr. Stockman, what do they say to you after it's all over? Oh, they all say I'm right. We've talked about this before. They say the same thing to you. Well, you're not on CNBC anymore, but which is dumb on their part. But they say the same thing to you, right? They all sit there and go, yeah, we can't say it. We don't want to be fired off the show, right? I mean, they all know this, right? That's the big game. That's why you're not hearing it.
Well, first of all, you're correct, but who cares? I mean, CNBC, no one really watches the show anyway. If they do, they listen to it on mute. So, I mean, I'm much more grateful to come on programs like yours, where you actually can have someone expound and develop a thesis without being cut off or be derided. When I was on CNBC, I was on twice a week throughout 2006 and 2007, and they really had me on there as a clown. I could be derided and laughed at.
They tried to, but they didn't. They weren't very good at doing that because you had the facts on your side. But go ahead.
Well, and when after the implosion, when they really felt, well, gee, this guy was right, and they really, phased me out until I was no longer on. I think 2015 or 16 was my last appearance. But really, who cares? I really don't care. It's much more important to me to get the facts right, the data right, and reach a conclusion based on the data. See, I run an actively managed portfolio. It's an inflation, deflation, and growth portfolio. So my priority is for my clients to make money and get things right. So I want to protect their principal and then profit from the third calamity in stocks since the year 2000, we're at the precipice. We've actually already started to go over the cliff, in my opinion. If you look at certain commodities, if you look at currencies, if you look at global markets, it's already here. It started, and the U.S. is not an island. So 2008 proved that without a doubt. The U.S. is not going to have 4% GDP growth while the rest of the world implodes. It's not going to happen. So it's important to me to not have an opinion and then look for data mining to back it up. I look at the data and reach a conclusion. And the conclusion is this is the most dangerous market ever. This is the most tenuous and precarious GDP on a global basis that we have ever had. And the reason why I say that is because we have never before, global central banks have never before printed $12 trillion. I'm going to repeat that. Global central banks had a position of $3 trillion. Their balance sheets were $3 trillion in 2007. They're $15 trillion today and still growing on the margin. We have never before had that happen. And the reason why they did that is to take sovereign debt into negative, zero and negative territory so we can go on this inflation quest so asset prices don't implode. That is all turned on its head. They've reached their inflation. They're starting to unwind, and this whole thing is going to collapse. And when it collapses, I think the primary beneficiary, unlike today, one of the primary beneficiaries is going to be the gold market. And it has suffered greatly. It suffered from 2012 to 2016. It had a little bit of a breather. Now the dollar is surging, and interest rate differentials are trenchant and very, very wide. So the gold is having a difficult time. However, this next recession, which is just beginning now, is going to cause central banks to once again go back into a dovish stance. But they're going from a dovish stance, Greg. Let's take the ECB. The ECB was never able to get off zero. They only got to a QE of 15 billion per month. Japan never got off zero and is still printing trillions of dollars, trillions of yen, trillions of yen per annum. I think they're on a pace of, I believe it's around 66 billion dollars worth, if you convert yen to dollars, per month.
Wow.
Of QE. And by the way, they own over half of the ETF market and almost all of the JGB market. So here's the question. When Japan enters a recession, what do they do? What does Mr. Kuroda, the central bank of Japan, do? Say, I'm going to lower interest rates? Well, gee, you're already at, zero and below. Are you going to go print more yen? And just, that's really not really worked at all. And likewise with the ECB. What are they going to do? Are they going to lower interest rates? Well, no, they're already zero and negative. And the Federal Reserve only has 200 basis points. So the margin of effectiveness of central banks has been diluted. It's been attenuated greatly. So their ability to rescue us from this recession is going to be very, very difficult. And that's why I say that they're going to have to resort to things like universal basic income, helicopter money, and negative interest rates.
Are they going to have to just write some of this off? I mean, we were talking about this in the pre-interview. I was talking about people like Martin Armstrong giggle. He goes all over the world, and he says, well, they all know we're never going to pay this off. Behind the scenes, they know we're not going to pay it off. They know they know it. You know this. You must talk to people over the world, too, that know this is never going to be paid off, right?
Well, that's the big, Greg, no, and that's the big secret. See, central banks around the world have to pretend that they can pay off the debt. They have to pretend that they can back their currency. So the Fed has a Federal Reserve note, which is backed by the assets that sit on the Federal Reserve's balance sheet. Once it becomes known that the balance sheet can never shrink, it can only grow, then faith in fiat currencies goes away. That's why the primary beneficiary of the next recession is going to be precious metals. Not yet. But it's going to have its time. It's going to have its turn. But that's the big ruse. That's the big game. I mean, the people who sit on the FOMC want to be able to pretend. In fact, they need to pretend. Because if they didn't, inflation would grow intractable and very quickly. If they came out, if the Federal Reserve, let's just say the recession ensues very quickly here, and the Federal Reserve says, I have to lower interest rates and I have to go back into QE. What's the governor? What are they going to use to retard inflation in the future? When is that going to ever happen? They know, the market's going to understand that the Federal Reserve cannot ever defend the value of the dollar. This is one of the reasons why I'm not on CNBC when you talk like this. Well, I'm just trying to be honest. That's why the Fed is going to be so reticent to admit that. They're going to stick with this rate hiking campaign and draining of the balance sheet as long as they possibly can until they have no other choice. And in my mind, that means you're going to have a stock market that gets completely wiped out. 30% to 50% before the Fed says, hold on, let's reevaluate.
And you think you're looking at, I've heard other people say, I've heard this before, but other people are really looking at this fall again. I mean, the fall's the time but you're saying that the data matches up to where we're already, the front of the car is hanging over the cliff. We've already gone over, not all the way, but you're saying that this October is when you think the fireworks are going to happen.
Yes, I do. I agree. The economy and the markets have never been more overpriced and never been more vulnerable, and that's when I see the confluence events to happen in the fall time frame.
Michael Pento.
Yeah, I just want to. Sorry.
All right, no. I want to hear what you have to say. Go ahead.
One more thing about the fall. If the spread between and we started the program with the yield curve, why it's so important. I hope I did a good job of explaining why it's mandatory and crucial and vital to watch that yield curve, because 90% of the time it says recession, and recessions bring the stock market down 50%. We only got 30 basis points left. If the Fed goes in September, that's 25, and if the spread between Fed funds and the 2-year remain where it is, well, then you're only going to have 5 basis points between the 2-year and the 10-year. And if they go again in December, we're going to have a full-on inversion. And that's assuming the 10-year note, as I said, the long-term interest rates are much more concerned about inflation and growth. And they're very loudly exclaiming the point that, hey, we believe the economy is going to slow and we're going to have a deflationary recession/depression. That's what the long end is screaming. Otherwise, when you have nominal GDP at 5% or higher, why is the 10-year at 2.85%? It doesn't make any sense. So that's the market, the free market, bringing down the 10-year. So the inversion is going to happen, the flattening and inversion is going to happen around the fall. And that is why I feel once the inversion occurs, then the panic really manifests full fold in the stock market.
And while I have you on here, because you said something about gold, people are going to want to ask, or they're going to want me to ask about. They should ask about silver. You should have asked about gold. You wouldn't be afraid of the prices right now. You'd be saying, "Ding, ding, ding, on sale, buy now." Is that what you? Judging by what you see with the data, and I don't sell gold, so and I know you don't either.
Yeah,
but you invest in it.
Here's my message: I have been underweight gold for much of this year, and happy to be so. My opinion is, the primary beneficiary after the recession becomes manifest is going to be gold. You got to get the timing right, and that's why you should be with an active manager who doesn't always say, hey, let's be short the dollar and long emerging markets and long gold because you've gotten crushed. So I have a very powerful, robust, back-tested model that tells me when to go long gold. And I believe the Federal Reserve is going to stop raising rates and stop draining its balance sheet when the stock market drops 30%, and that's after the yield curve inverts. So sometime between now and the fall, perhaps November, December, the end of the year, that is when it's going to be time to rush into gold. But you should always have at least 5 to 10% of your position in gold, and you have a nice, like you mentioned, as you mentioned, this is not a bad price to get your feet wet. If you're waiting for an opportunity, you're running out of time to get it cheaply.
Oh, okay. All right. So you would not be as sheepish about being a buyer right here, especially for little people that want to buy physical silver and physical gold. There's not a lot of downside to for gold and silver right here.
I don't think there's a lot of downside left, and you're running out of time to get in if you don't have any position at all.
Ah, very good. Very good. Michael Pento, Portfolio. strategies. He wrote this book a few years ago. He lays out what's happening right now in this book. I wish you would have updated this book. You'd have been a huge bestseller. But still, you could go get this book. It's on the front page of your website, pentoport.com. I'll put up all the links. Michael Pento, thanks for joining us today on USAWatchdog.com.
Thanks as always, Greg.